Good afternoon, everyone. Good afternoon and welcome to the webinar. My name is Ted Everett, Boston's Programs and Education Advisory Council. Today we are presenting a conversation with Ben Inker of GMO. Topic: value is the trend for real this time. Before making speaker introductions, I want to mention some other upcoming events real quick. Another in our series, ESG series on May 4, Understanding the Evolving S Landscape Through Its Foundation in Human Rights. May 11th, another in our distinguished lecture series, Who Owns and Trades Bitcoin? And May 26th, The Case for Inflation, A Deeper Look Beyond the Headlines. That's featuring Eric Weissman from MFS. Those are at all different times, so please check the website for those events. Now, Ben Inker is head of GMO's asset allocation team and a member of the GMO board of directors. He joined the firm in 1992 following the completion of his BA in economics from Yale University. In his years at GMO, Ben has served as an analyst on the quant, equity, and asset allocation teams, as portfolio manager for several equity and asset allocation portfolios, as co-head of international quant equities, and as CIO of quantitative developed equities. He is also a member of the investment committee for Yale's endowment fund and is a CFA charter holder. Joining him today and moderating this conversation is Catherine Delaney. Katie is a partner at Brown Advisory in the Boston office, where she manages portfolios for families, endowments, and foundations. Prior to joining the firm, Katie was managing director at Cambridge Associates, where she similarly advised families, endowments, and foundations on asset allocation and manager selection. Her experience interviewing and selecting asset managers gives her a very good perspective to lead today's conversation. Katie has also worked for Blackstone Group in New York and BNY Mellon Private Wealth Management. She holds a BA from Georgetown and an MBA from Wharton, is a CFA and a member of 100 Women in Finance. Before I turn things over to her, I want to note we will be taking questions. We'd prefer to take them at the end, and if you would put them in the Q&A rather than the chat box, we prefer that. And slides will be available later. That question also always comes up. I also need to remind attendees that even though we are virtual, as a general rule, the press is not invited to these programs, and Chatham House rules apply to this presentation. Chatham House rules are defined as a meeting where participants are free to use the information received, but neither the identity nor the affiliation of the speaker nor that of any participants may be revealed. With that compliance chore done, Katie and Ben, over to you.
Great. Thank you, Ted. And thank you everyone for joining, and especially to you, Ben. Thank you for joining today. I've been really looking forward to this conversation and appreciate you taking the time. So we're here today to discuss the case for value, and clearly over the past 2 quarters since you wrote your piece in the fall entitled Value, If Not Now, When? The market has certainly answered that question you posed with a resounding yes, now. Value stocks have clearly experienced a solid bounce in absolute and relative performance after a very difficult period. And so before getting too far into the weeds in terms of looking at value and growth and how they compare today, I think it would make sense to begin with how GMO defines the value universe. And could you walk us through your methodology and how you construct your price to fair value model?
Sure. So at GMO, we've kind of got 2 varieties of value models for stocks. One of them you can think of as kind of a robust traditional value model where you're looking for companies that are trading at cheap levels relative to kind of the standard fundamentals that one tends to compare prices to, albeit where we've done a fair bit of processing of those fundamentals to try to make sure they're as economically meaningful as possible. We also do have a model that you refer to as the price to fair value model. That is a dividend discount or discounted cash flow model that we use using the inputs from kind of those more traditional valuation models, but where we are trying to forecast the next 20 years of cash flows from corporations to come up with what we hope to be a kind of intelligent and forward-looking value measure across all companies. Normally, when I'm talking about value stocks as a group, as a kind of style, I'm referring more to the simpler, more traditional valuation metrics rather than kind of our idiosyncratic price to fair value model.
Great, thank you. And so, in thinking about some of those traditional metrics, one common thing, I think people talk about is just, how has that thinking evolved in terms of, the usefulness of those metrics, particularly with so many companies having asset light compositions. And so how do you think about that?
Yeah, I think it's kind of the key challenge for anyone who wants to use a stock value model, particularly someone who is doing this on a more quantitative fashion, so that you can't come up with very detailed forward-looking forecasts for every company. So what we try to do is make sure that the fundamentals we're looking at are as close to kind of the Platonic economic ideal as we can make them. And so when we're looking at things like earnings or book value, we're making a series of adjustments for each company, where what we're trying to do is say, yeah, whatever the GAAP or IASB accounting standards may be, we want to be doing something sensible. So we will go in and look at the various pieces of expenditure and try to decide, is this something that should be capitalized versus expensed? And for kind of types of expenditure that strike us as very investment-like, we will capitalize them over a varying length of time, depending on the kind of expenditure and the kind of company it is. We also want to make adjustments for the asset values of companies, not just for those investments, because after all, if you are capitalizing something, it should be on your balance sheet for some period of time. But the other key problem for kind of traditional valuation metrics, or at least price to book, which is kind of the oldest valuation metric, well, maybe not older than PE, but certainly the Fama and French approved old style metric. The biggest problem there is less asset light companies and more changes in the way companies make their financing decisions. That it was the explosion in stock buybacks that really made book values cease to be meaningful. And so in addition to the adjustments we make on the income statements, we try to adjust each company's balance sheet for any distortions that would come from their issuance or buyback activity, to try to get, again, something closer to the idea of what book value should be, whether or not the GAAP measures agree with that.
Great, that's really helpful background, Ben. In an effort to make this somewhat interactive and know who our audience is, we did want to do one quick poll question before diving into the case for value today. So if we could bring up that first poll question, Jamie, here we are. Do you or your firm focus your investing strategy on value? So if everybody could answer that, that would be helpful. See how the results are coming in here. Give it a few more minutes. Great, so looks like we have a fairly balanced audience. Invest in either strategy as conditions dictate with 40% of the results. We do have a slight tilt to value oriented investors at 26%, growth at 9%, and I guess no real style focus at 26%. So great, good to know heading into the conversation. So moving on, so Ben, you've been fairly vocal, particularly over the past year, about GMO's view that value is positioned to experience a significant recovery in relative performance versus growth. And now that we've started to see that over the past 6 months, could you give us a sense of where we are today? You know, is value still extremely cheap in your view?
Yeah, I mean, we have seen a nice rally in value. And so that is absolutely kind of a very relevant question. I think this chart does do a decent job of putting it into perspective in terms of the scale of the recovery we've seen in value relative to the pain we suffered coming into this. So this is just a chart of the Russell 1000 value versus the Russell 1000 growth. You know, our definition of value is a little bit different than this, but this is kind of the standard index. You can see value has underperformed starting in about 2006 or 2007. And that has been both the longest and deepest period of underperformance for value, certainly going back the last 50 or 70 years. The recovery we've seen so far is material. But there have actually been a couple of periods during the down leg which were similar in scale. So one thing I do have to admit is I am hoping we got the timing reasonably right on calling the bottom here. But it is too soon to know. This is a nice rally, but it's not outside of the realm of kind of bear market rallies you can see in a style. But we do think, even though value was overvalued in 2006 and 2007 when it's hit its peaks, there is a lot of scope for value to continue to outperform in the months and years to come.
Great. And, you know, I think one of the interesting parts of your letter from last fall was just you looked at a variety of different metrics, as we talked about earlier, and, you know, the headline being value is cheap no matter how you define it. And so one question is, you know, when you look at those metrics today, have any of those shifted in the recent rally, or has anything changed in terms of that view in our, you know, in terms of those factors? And, you know, is it more complicated now, or is it still the same? It's cheap across the board, sort of equally.
Yeah, value is still very cheap almost every way you look at it. It's less, it is a little bit less extreme than it was in the fall. And certainly what we have seen is a strong recovery in, let's say, the COVID sectors, right? That's not a group of, that's not necessarily a group of stocks that would historically have been defined as either value or growth. But when COVID hit, they got hit really hard. And we've seen a pretty strong recovery there. So if you were to look at the COVID sectors, they have had a somewhat disproportionate recovery. We think you can still definitely find value there. But as we see it, value still looks very cheap, really around the world. It looks cheap on a sector or industry neutral basis. It's a little bit less close to kind of less closely allied with the cyclicals than it was 6 months ago. But the basic pattern that almost any way you want to look at value, the spreads are much wider than normal. That is absolutely true.
And, you know, you mentioned the non-US markets. Maybe you could just touch on, you know, any differences you see in the value opportunity, you know, here in the US versus internationally. I think most people are familiar with, you know, GMO's view on emerging markets value, but also areas like Europe and Japan. You know, how are you thinking about valuations globally?
Yeah, so the basic pattern between value and growth looks very similar everywhere around the world. Last year, the year 2020 was the worst year for value relative to growth in every major region in history. And value came in cheap at the beginning of 2020 in all of those regions. So anywhere you look, value looks really quite cheap. There are some nuances to it, I guess. One place where we're actually particularly enthusiastic about value right now is Japan. There's a couple of reasons for that. One is the value recovery in Japan has been a little bit less sharp than it has been some other places. But the other thing that we quite like, particularly when we're talking about traditional value rather than thinking about our particular value models, is in general, the balance sheets of value stocks in Japan are really quite pristine. If you look, in say the US or the UK, the last decade has seen a pretty extraordinary buildup of debt in the median company. So you see debt ratios that look really quite high and get us a little bit nervous about particularly some of the small cap value stocks in those places. But one of the nice things about Japan is more than half of the market has net cash on its balance sheet after you subtract out all of their debt. So not only are the companies pretty cheap, but they've got a really easy way to increase their return on capital by just freeing up some of that cash. And we don't have to worry about what happens if the recovery has more hiccups than people are expecting. So we like value everywhere on a relative basis. The places where we like it the best are the places that are absolutely cheapest, so emerging, or a place where the spread is wide, the valuations are okay, and kind of the underlying risk of bankruptcy is very low, which would be Japan.
And I know you have a slide looking across the globe. Maybe it would be helpful to land on that just for a moment.
Sure. So just to make that slide a little bit easier to read, this slide, which comes before it, this is just looking at the valuation of value relative to growth in the US. On this slide, 1.0 would be the long-term average. And right now, as of the end of March, we're trading at about 0.62. That is 7th percentile relative to history. And just to put it in perspective, if you were going to go from 0.62 back up to 1, that's, if my math is right, and it probably won't be, somewhere between a 55 and a 60% relative return. So I don't want to show 17 of these charts, but if we just take that percentile number at the end and look at that across regions and in different ways of slicing value, what we see is that value looks really very interesting everywhere around the world. So the slide we just saw is now the number in the upper left-hand corner of this table, US broad market value relative to growth. Now that does include small caps. You could ask the question, oh, well, is this just that small caps are cheap and maybe the small caps are more vulnerable? Nope, it looks almost exactly the same in large cap. If you do this on a sector neutral basis, it's slightly less extreme, but again, we're in the 16th percentile relative to history. One of the questions we have gotten a lot is whether the apparent cheapness of value is driven by those sectors that have a lot of intangibles and therefore where traditional valuation metrics might have a harder time coming up with reasonable numbers. It turns out, and this is more strikingly true in the US than anywhere else, actually the spread of value in those industries that have lower levels of intangibles is much wider than it is in those levels with those sectors with high intangibles. The other question that we get a lot is whether this is being driven by those industries that are dominated by a few massive monopolists or oligopolists. What we find in general, and this is particularly true again in the US and Europe, the spread of value is actually wider in those industries that are more competitive and a little bit narrower in those industries that are more concentrated. So as we look at it, value looks very cheap. It looks very cheap around the world. And those kind of standard questions that people have about whether you can trust it, what we find is if you're concerned about those things, all right, you could look at value only in low intangibles industries or only in competitive industries, and you'll see a really interesting opportunity.
You know, one thing I heard you speak about, Ben, it was, in the US, investors have been willing to pay up for growth, whereas in places like Europe, it's been more paying up for quality. Is that still the phenomenon in some of the maybe markets that are considered lower growth?
Yes, it certainly is the case that there are simply fewer secular growth companies in Europe than there are in the US. And the fact that the spread of value is similarly wide is more driven by those kind of defensive growth companies, the more the consumer staples type names. So one of the things that we actually quite like about looking at value globally is that you're not simply betting on the same factor, right? In the US, looking at traditional value is giving you a big bet against IT. Now, we think you can do this with a much smaller bet against IT, but in Europe, since there aren't that many IT firms, it's not really about that. And in Japan and emerging, again, the characteristics of what you are long, and if you're going to be short on the expensive side, what you are short are quite different. And we like that diversification, given that in addition to owning portfolios that are long undervalued companies, we are also running a long short portfolio where we are explicitly short overvalued companies.
Great. That's really helpful. So, I think we've established that your view on the cheapness of value across, all of these metrics. And so the next natural question would really be, what are the drivers for value to outperform from this point forward? And, I know that you look at it from a variety of different factors. So maybe you could walk us through, your thinking there.
Sure. Whenever we're looking at a group of stocks or almost any asset where we can define fundamentals, we really like decomposing all of the returns into their underlying components. And I think that's particularly instructive in the case of value. So this is a chart looking at the components of return for value. And I've broken it up into two time periods. One where value did quite well versus growth. The other where value has underperformed growth. Now, this is for our valuation metrics. Some of that is because we don't necessarily have the constituents for a traditional value index going back as far as we might, but we do for all of our models. So in the period from 1983 to 2006, value did quite well versus growth, outperforming by 5.5 points a year. If we look at where that came from, there's this kind of folk wisdom that basically the way value gets you your return is through income. And that's not entirely untrue. But one of the things you realize when you break down returns this way is that that is far from all of the story. So if we're trying to break down where that 5.5 points a year came from, over that 23-year period. It turns out 1.5 points of that came from valuation. And what does that mean? That means that value stocks were trading at a smaller discount to the market in 2006 than they were in 1983. And on average, you made an extra 1.5 points a year from the fact that those valuations were rising. So the sustainable return from value relative to growth wasn't actually 5.5 points a year in that period. It was only 4. Now, 4 is still pretty good. Where did that come from? Well, a piece of it did come from income. If we look at the second set of bars to the right, you got about 2.5 points of extra income from value. Now that's income from dividends, but also income from net issuance activity, including both stock issuance and buybacks. So that extra income clearly wasn't enough to get you the 4 points you outperformed. The other obvious piece of return for stocks is growth. And here is where you see value has a profound problem. They undergrow. They undergrow growth stocks by quite a considerable margin. In the period where value did well, they were undergrowing by almost 8 points a year. And the combination of 2.5 points of extra income and minus 8 points of growth should lead to profound underperformance, and yet they won. So why is that? The reason why is this other term at the far right, which we're calling rebalancing. This takes into account the fact that value is not a static strategy. If you are buying the cheap half of the market every year, you are tossing out some of the companies you owned last year and buying some others. And that change in the components turns out to accrue very much to the benefit of value. And why is that? Every year, a couple of companies go bankrupt, but not very many. A few companies may become so small as they fall out of the universe. It's a little bit, but the biggest reason why a company that was in the cheap half of the market is no longer in the cheap half of the market a year later is because it got more expensive. And it graduated to growth. The process of a value stock graduating to growth is almost invariably really good for shareholders of that company, right? It has gotten re-rated. It's probably gotten re-rated because its fundamentals did better than people were expecting. And so that rebalancing was worth almost 10 points a year in favor of the cheap half of the market. The growth side has the reverse issue, where the companies that you no longer own a year later in your growth portfolio are the ones who disappointed. And their fundamentals were less good than you wanted. Their valuations fell, and then they disappear from the expensive universe. So that rebalancing is really quite bad for growth. And so it's that piece which people have a tendency not to think that much about when thinking about value, and particularly when thinking about growth. That is really a key contributor to the long-term returns to value. But looking at what changed between the period where value was winning to the period where value was losing, hey, it did 8 points a year worse, which is very painful. The undergrowth was almost exactly the same as it was in the prior period. So it's not that these companies were doing a lot worse. It's not that they all became value traps. They undergrew, but by a similar amount to what they had done historically. The income benefit was almost exactly the same, a little bit higher, which is frankly a little bit of a surprise, but it turns out the value stocks had a very high payout ratio in this period. The rebalancing was a little bit worse. The reason for that is, and this is one thing that definitely did accrue to the benefit of growth in this period, the average growth company stayed a growth company for a little bit longer. It's one of the things about growth that no company, you should never expect any company to be a growth company forever. Growth is generally a feature of the young. We see that in humans, but we also see it in companies. But we did see a series of companies, most notably the FANGs, that have been able to maintain their status as growth companies at sizes that historically that has been very difficult. That has meant that the rebalancing in favor of value and against growth has been a little bit less good. But the key difference between that earlier period and the more recent period is that second set of bars labeled valuation. Value stocks underperformed growth by 2.5 points a year in this period. They got cheaper by over 5 points a year. So it is that falling relative valuation that has been the primary driver of their underperformance. And the reason why we are bullish on the performance of value going forward is, in the long run, that valuation bar should really be pretty close to zero. It doesn't make sense to have a long-term material trend either upward or downward in that relative valuation. And if we were to replay the last 15 years and have value traded the same average valuation it did, but have it be static at that level, value would have won. So in terms of how can we have confidence that value isn't dead, it's because in the absence of a strong negative from that bar, the other fundamentals have been good enough that value deserves to win. Now, the reason why we are pounding the table on, let's say, a cyclical, in a cyclical sense for value, is that having seen their valuations fall by 5.3 points a year, they are trading at some of the cheapest levels we've ever seen. And the likelihood is those levels are going to come back up. It's even possible if they don't come back up, our guess is that that rebalancing would be significantly larger than we've seen historically, because with such a wide spread, a company moving from value to growth actually has a huge benefit in terms of their valuations, much bigger than it has been historically on average. And again, for the growth guys, that negative is kind of pretty horrifying. If you have been treated as a growth company and you get demoted to value, that's a pretty large capital loss.
That's really helpful. I mean, I think a lot of people focus on the valuation, growth, and income, and the rebalancing factor is just not that intuitive or known to most people. So thank you for walking through that. I just say along those lines of, a catalyst for value outperformance, there's been a lot of talk about the impact of rising rates, and that's clearly on the minds of investors, and the impact that could have on stock prices, particularly growth oriented businesses with the long duration of their cash flows. And I know that you've written about the fact that that conventional thinking is not necessarily the case in terms of being more of a detriment to value, or more of a detriment to growth than value. So could you just expand on that a little bit? Because I think that that's kind of a key topic these days.
Yeah. So the underlying intuition behind the idea that growth is a much longer duration investment than value is very intuitively appealing. And if you think of value giving you its return primarily from income, then falling interest rates and rising valuations for equities create a problem. So if the stock market just to make the math pretty simple, let's say you want to get 6% real from stocks, and value stocks give you in that world 4% in income and 2% in growth. Okay, you've gotten to your 6. Now, if we double the market and they maintain the same growth, you've got a problem because you've lost 2 points of expected return. Whereas if you looked at the growth end of things and you say, oh, they're going to give you 5 points of growth and 1 point of income, if you double the valuation of the market, you've only lost 50 basis points of income. So it seems as if growth should be much more sensitive to a change in the underlying discount rate for the market. What that misses is that rebalancing effect. The combination of growth in income for growth as a style is much higher than the actual returns that growth investors achieve because of that negative rebalancing effect. And so if we saw a world where there was this permanent increase in the premium that growth stocks traded at and the discount that the value stocks traded at, that rebalancing effect would get very large and positive for value and very large and negative for growth. And what it means is that it probably doesn't make much sense for those valuation gaps to move a lot. It is certainly the case that growth as a style is a slightly longer duration asset than value as a style. But at the end of the day, both styles are equities. Equities are a pretty long duration asset to begin with. And if you think about these as activities, the difference in the expected return from a change in the discount rate to the market is really quite small between value and growth. Now, that said, rising interest rates could easily be a catalyst for value to recover, right? My argument is today's low interest rates don't justify the low relative valuations for value, but something is going to cause people to change their mind about it, hopefully. And you know, that is likely to be driven by some meaningful change in the kind of overall environment. An obvious change would be the inflation or interest rate environment. And even though I think the narrative is a flawed one, that doesn't mean it is not a widely held one. I must say there's something a little bit mystifying to me. If you told me somebody who owned Apple Computer was saying, look, I think I'm going to get 3% real from Apple Computer because it's trading at, I don't know, 33 times earnings. And I assume I'm going to get basically the earnings yield. And I'm okay with that because I'm going to get minus 50 basis points real in the treasury bond. And so I own this thing because interest rates are low, even though the valuation is high relative to history. 3% real from this high quality company that I believe is going to be around in 20 years makes sense. I have a really hard time believing anybody investing in Tesla is doing that analysis. It can't possibly be that people are saying, do I want to own Tesla or do I want to own a treasury bond? And frankly, I have a hard time believing that the people who are owning Tesla are doing it on the basis of anything close to a DCF analysis where you'd plug in a discount rate. They're doing it on the grounds that Elon Musk is going to change the world, or man, look how cool this company is. The narratives can easily change, and narratives are driving this market in a way that, frankly, I haven't seen since the internet bubble in 2000. I don't know exactly what's going to change those narratives, but interest rates is as good a possibility as anything.
Great, thank you. So I have a couple more questions, but we wanted to do one more poll question first. So we could bring up the second poll question. Now that we've talked a bit about the case for value, are you considering altering your value allocation in portfolios in the next 6 to 12 months? So just be interested to hear what the audience has to say about this. Give it another minute. Looks like we are landing on an increase overall. About half the audience so far looking to increase value. Very few looking to decrease value, and several not making any change. So that's helpful to know. It seems maybe you're getting through to people, Ben. Okay, great. So I know we've spent a lot of time talking about equities, mostly in the US, a little bit about non-US, but wanted to just spend a moment on, the 7-year asset class real return forecasts. And, in looking at those clearly, and maybe we want to flip to it, it's a pretty dire picture. And so I think it would be helpful to just, if you could walk us through a bit about how you arrive at these assumptions, and 2 specific questions that come to mind are, why 7 years? And also your thinking around inflation assumption here, just given where we are, with massive stimulus and debt expansion that we've been experiencing. So I'd love to hear your thoughts on that.
Yeah, so the 7-year forecast, we kind of started off doing these 25 years ago. We made them 10-year forecasts at the time because 10 years was a nice round number. We hit upon 7 on the grounds that we looked at how quickly mean reversion appeared to occur. And basically, from any given point, you seem to move in a year about 1/7 of the way back to fair value. And so we kind of build a forecast based on that. Now, that's not universally what we're doing in the forecast, to be honest. What we find is value has a tendency to revert back to the market somewhat more quickly than the overall market tends to revert. And the kind of the subtle point, which we don't do a great job of explaining on a single page, is this is really a forecast assuming we're going to go 1/7 of the way back to fair value next year. Next year, if we're also going to go 1/7 of the way back to fair value, that negative is going to be a little bit smaller for anything overvalued, and the positive is going to be a little bit less positive if you're moving back up. Today, what we find is that everything looks expensive relative to history. Now, that may mean that things aren't that crazy relative to each other. And I think the best argument I can come up with that can justify the general level of equity valuations around the world is the level of bond valuations around the world. We've got 2 scenarios that we look at here. In building the portfolios, we actually use at least one other, but for these purposes, it's complex enough. The mean reversion is kind of the old style forecast we've been doing since 1995, which assume that the fair value everything is returning to is something pretty close to the post-World War II average. So the fair valuation for equities would be a valuation consistent with earning about 5.5 or 6% real. Fair value for bonds would be giving you 2.5 to 3% real. Now, the issue is bonds have obviously been quite expensive relative to that for a long time, and stocks in various places have as well. About 7 years ago, we started putting out these partial mean reversion scenarios, which assume that the required return to equities has dropped to 4.5 real, and the required return to bonds has dropped to about 1.5 real. Now, today, the valuations of bonds are a lot lower than even 1.5 real. And we think the valuations of a lot of stocks aren't sufficient to give you 4.5% real. If it is truly the case that inflation is no longer a fearable menace in the developed world, then maybe today's very low interest rates are sustainable. Let's assume, let's simplify a little bit and say, okay, the required return to bonds is going to be 0% real. So same as inflation. In that world, well, maybe you need 3% from equities. Most equities around the world are priced to give you a little bit more than 3%. In the US, we think they're probably priced to give you somewhat less than 3%. So we have a hard time being excited about US equities even in that world. But in that world, assets look kind of sensible. Honestly, the thing that scares me is we don't understand why inflation disappeared. And frankly, in the US, you know, in Japan and Europe, you could argue that inflation really did disappear in the last 20 years. In the US, we've merely had inflation of almost exactly the Fed's goal. So my concern is if inflation were to rise from here, today's valuations are really not sustainable anymore, because cash yields are going to rise, bond yields are going to rise. In that world, you really need more than 3% real in the long run from equities, which makes equities look pretty expensive. And because equities are such a long duration asset, you should expect to actually take a larger loss in an equity portfolio than you would in a standard bond portfolio, because equities, with regard to their underlying discount rate, have a duration of somewhere between 20 and 30. Whereas, you know, the ag has a duration of something like 6. So I worry that asset prices are vulnerable if inflation were to come back. I will admit, I am not certain by any means inflation is going to come back. But man, if I was trying to design a set of policies to try to get it to come back, they wouldn't look that dissimilar from what the world is doing right now.
And so, you know, just to elaborate a little bit on the US piece of this, because we spent so much time talking about the case for US value, yet when you look at the US large and US small, you know, forecasts, they don't look great. So do you break it out for US value specifically? And are we
do. And the spread between value and growth for us within the US is quite wide. But on a long only basis, frankly, I prefer value anywhere else in the world to value in the US. I think the value opportunity relative to the US market is as good as it is anywhere. But if you look, say, in our unconstrained multi-asset portfolios, the long equities we own, we've got about 30% of the portfolio that's in long equities. That is a combination of emerging markets value and Japanese value stocks with a little bit of European small cap value as well. We've then got a chunk, we've got about 20% of the portfolio that's in a value versus growth long short. And there, about half of that portfolio is in the US, because US is a big liquid market and there's a wonderful spread of value. But I have a hard time being excited about value in absolute terms in the US, given that the valuations of the stocks in absolute terms, we can find much cheaper ones when we leave the country.
Got it. That's helpful. Okay, I think at this juncture, we want to get to some of the great questions that have popped up in the Q&A. So Ted, you want to take that?
Sure, we got some good ones here. So I'm going to go back to earlier in the presentation. One that's simply asking if the market's due for a significant correction, why not wait until it happens before allocating to value? I think I know the answer, but
yeah, I guess there's kind of a couple of things. One is, look, I think the market is overvalued. I can tell you after 30 years of my career, I really suck at timing. And sitting around in cash I am certain I am going to lose ground relative to inflation. Now, if I can find other useful things to do that have positive expected real returns, I'm happy to do that. And going back to that unconstrained multi-asset portfolio, we've got 20 points in this value versus growth long short. We've got another 20 points in kind of other liquid alternative strategies, whether merger arbitrage or kind of systematic global macro or other RV type trades. I don't want to sit around in cash and wait for the market to collapse, because I might be waiting a very long time. But certainly I am much more confident I'm going to get a positive return in the US going long value and short really overvalued companies over the next 3 to 5 years than I am that I'm necessarily going to make money long only in value. As the time horizon lengthens, the argument for just owning relatively cheap stocks and not messing with it gets better and better. But over the next 1 to 3 years, I worry, particularly if we got inflation, that, you know, from a long short perspective, value deserves to outperform very much. But in long only, particularly in the US, the likelihood of a loss in that scenario is pretty high.
Do you actually have a estimate along the lines of your 7-year outlook for US value?
We do. It's strictly speaking not a 7-year estimate, but a 3-year estimate. Right now, I think we, you know, it's probably about 5 points a year better than the broad US market. Again, that's for kind of more.
So a -2 something return?
Well, that -2 is assuming that the market needs to be priced to deliver 5.7. So again, the more you believe that today's interest rate regime is going to be sustainable, the more you wind up looking at the partial mean reversion or kind of an even more extreme version of that. So you can get to small positive expected returns for US value. It's just in that world, man, Japanese value and emerging value are really cheap and deserve to give you double-digit returns. So even if I believe that today's interest rates are here to stay, I can definitely find assets I like better than US value in absolute terms.
Mm-hmm. Another question here, investor interest in ESG, which tends to be growth and quality, has accelerated. How do these flows affect the prospects for value?
Yeah, so value doesn't have to mean, you know, dirty, ugly companies. And certainly in our, you know, in our price to fair value model, and indeed even our more traditional valuation metrics, we make adjustments to the value or the valuation we are prepared to let stocks trade at for their quality characteristics, including ESG type indicators. So our view is, yeah, ESG matters. It primarily matters from our standpoint because it tells you things about what the future return on capital is likely to be for companies. And that alters what you should be prepared to pay for them. So we think you can put together a portfolio of undervalued companies with kind of however stringent an ESG screen you want to have. All of our valuation metrics do some tilting in favor of higher quality companies on ESG and other measures. And we think it doesn't really look that different. You don't have, the surviving coal companies may indeed look cheap relative to traditional fundamentals. I'm not saying you got to own them. And I'm not saying, on our models, they necessarily look cheap. But you can find plenty of companies that look shockingly undervalued relative to the market, even though you're making adjustments for environmental, social, and governance metrics.
We are coming up on the hour. We've got a few questions left. I just warned folks we might go a little bit over one, if that's all right with you. Another question here, and I think I can guess the bias of the questioner. Does emerging market value deserve higher multiples? Shouldn't commodity companies and emerging market banks trade at lower values?
Yeah, so it is one of the things that is going on under the surface of our forecasts. Is there are two groups of stocks that we actually remove from our universe when both looking at broad regions like the US or emerging, and also the style, the style groups. And those groups are in fact banks and resource companies. The reason why is because they're two groups where valuation metrics can be much trickier to try to follow as a guide to the attractiveness. In the case of banks, the basic problem is if a bank is trading at a big discount to tangible book value, it may be impossible for it to recapitalize in the event that it hits a rough patch. And the problem with resource companies is it is difficult to value them accurately if you don't know what's going to happen to the commodity price. So when we're looking at EM value, we are explicitly looking at the EM universe X the banks and resources and looking at the cheap half of that. And that group looks very attractive to us. Now, if you look at our actual resultant portfolios, we do own banks and we do own resource companies, and the resource companies actually do look quite cheap today. But you absolutely don't need to be considering them in order to think that EM value looks attractive. And it is certainly the case that there's one of the things that gets tied up in emerging. You've got resource companies, you've got state-owned companies. And actually, an awful lot of the state-owned companies are actually resource companies. And it is very clear that those companies should trade at a discount to the broad market. If you think about a Gazprom or a Lukoil, where you as an outside shareholder are not that high on the list of people they care about, that is a company that darn well better be trading at a pretty low valuation in order to entice you to invest. Right now they happen to be, so we think they should be considered ownable by investors, but we don't treat them the same as ordinary companies, and they're not part of our 7-year forecasts at all.
Okay. Do you feel that commission-free trading, this easy monetary policy and fiscal stimulus has led to a paradigm shift in a way we expect valuations to revert? Are higher valuations here to stay? Is it different this time?
If it's different this time, I think the strongest argument for why it's different this time is because interest rates are never going to go back up. If we're truly going to be in a world where the equilibrium cash rate is negative after inflation, the required return to everything else should be lower, and sustainable valuations should be higher. The way we got here, right? If you think about the Fed, they have two goals: controlling inflation and maximizing employment. If inflation is no longer a thing, then they only have one goal, which is maximizing employment. And that always argues for keeping rates as close to zero as you can. I am skeptical that a world that is no longer worried about inflation is going to be one where inflation can't come back. And again, you know, the talk about today's fiscal and monetary regime, this is exactly way back 30 odd years ago when I was taking macroeconomics. This is exactly what they would have said would lead to inflation. So a lot of what I learned as economics 30 years ago turned out not to be correct. But this is a set of policies which is wholly different from anything we have seen across the world in peacetime. And I think is more likely to wind up with an inflationary outturn than whatever has come before. Still, I don't know why inflation went away, and I'm not 100% sure it's going to come back. But if it does, this paradigm will not survive. And frankly, commission-free trading, I think, is kind of a plague on retail investors. I think retail investors are not well served by anything that encourages them to trade more. And commission-free does not mean that the trading is in fact free. And it certainly doesn't mean that the type of trading they are likely to do is going to give them a good return. So I think net that will not have turned out to be a real benefit for retail shareholders.
Well, I think Robinhood and its ilk are a whole nother topic of conversation. I want to squeeze one more answer in. I also want to thank you for making a plug for our presentation on inflation at the end of May. Find out what we really think is going to happen. One final question. When you say you prefer international value versus US value, how might you factor in COVID vaccination rates and potentially slower recoveries abroad? Or is this too short-term a phenomenon?
In general, I think of that as too short-term a phenomenon to really impact fair value for the vast bulk of countries. We have been putting together a sort of set of COVID resiliencies and COVID effectiveness across countries. The US, frankly, didn't look particularly good on that until our vaccination drive really kicked in. But there is sort of hope for the US on the back of vaccinations in a way that there is not yet in a significant, in a lot of the rest of the world. But the reality is that is about 2021. Equities are really long duration assets. As long as you're dealing with a company that has sufficient financial strength that it's not going to go bust if things are tough for the next year or two, this year's cash flows are kind of a very small piece of the overall. And compared to the general premium you pay for a US stock relative to a comparable non-US stock, our preference is for the non-US variety. Okay, well, that's great. I think we've taken enough of everyone's time today. I want to thank Ben and Katie for a really interesting conversation today, and all of our attendees for attending. And with that, we will thank everyone and say goodbye. Thanks again.